get the record going. I want to welcome you all to Understanding Financial Reports. We have Nicole Urbane with us today. She's with the Northeast Massachusetts SCORE chapter. And we also have East Cambridge Bank joining us, East Cambridge Savings Bank joining us today. And they'll be available at the end as well to answer questions. So we are very glad that they're here with us today. We're going to start with, before I go into a little bit about SCORE, I'm going to go ahead and introduce Robert Nichols, and he's going to tell us a little bit about the bank's role.
Thank you, Teresa. I appreciate the introduction. And thank you, everyone, for joining the webinar this evening on the topic, Understanding Financial Reports. SCORE has been a great partner to work with, and we continue and are willing to provide these outstanding workshops. East Cambridge Savings Bank is a mutual savings bank. We are not a publicly traded company, and we do not have investors. Mutual savings banks have been around since the early 19th century and are still common in New England. Our bank was founded in 1854 and has been operating with the same name and charter since then. We have never been acquired or sold to a larger bank. Since East Cambridge Savings Bank is a mutual savings bank and does not have shareholders, we reinvest profits locally through mortgages, loans for small businesses, and supporting nonprofit organizations. Back to you, Teresa.
Okay, great. All right. So I want to tell you a little bit about what role SCORE plays. I apologize. Get things out today. So SCORE has a couple different roles in the small business community. One is offering training, which you guys are here with us today for this webinar. We also, and what most importantly we do, is offer free and confidential mentoring. Our mentors come from all different backgrounds and experiences, and they're sharing their knowledge with people that are thinking about starting a small business, are in the process of starting that small business, or already have a small business and are growing. So a lot of times people ask me, what is a mentoring session like? It's a very casual environment. The sessions usually range in the 30 minutes to 45-minute range. Sometimes they'll go up to an hour, but not very often. And especially in that first session, it'll be about sharing where you're at and what your goals are. And a plan will be put together to help you progress to those goals. The mentor will have resources they can share with you and their experiences that they can share with you. So if you don't have a mentor and you'd like to get one, this is how you can do it. You can put a note in chat, or you can reach out to the one of the websites here. I will put those into the chat so you can connect directly here in a few minutes. If you don't want to get a mentor through the website, just visit. There is so much information on the website, tools and templates, and a library. There's previously recorded webinars that you can watch. Just a ton of information that you can take part of. Okay, we do anticipate a pretty decent crowd tonight. So I would ask that you please use the Q&A tab. Those questions in the Q&A tab will be asked to our presenter at the end. You will be able to ask Nicole, our presenter today, questions, and you can also ask questions of the bank on how financial reports, how they use financial reports at the bank, any of those types of questions. So both people will be available for questions at the end. You can use chat for everything else, and that's completely fine. Okay. Oh, it's blocking my screen. Okay, I'm going to go ahead and stop my share, and I'm going to turn it over to Nicole. It's all yours.
Thank you, Teresa. Thank you, Robert. So let me share my screen and get started here. I hope everybody can see my screen now.
Yes, you're good.
Okay, good. I take this as a yes. Okay, so yeah, for today, I brought a little bit about financial reporting. This session is intended to give you a high-level overview of what financial reporting is, how it comes about, and what's actually very important in financial reporting. And hopefully you can build your comfort with it, and you can sort of, and it enables you to sort of have the relevant conversations with your accountant or bookkeeper, and give you some food for thought. These are kind of the goals for today. So our agenda is very simple. We're going to talk about the why. Why is financial reporting important? What does it entail? When should you do it? And how can you do it? So let's start with the why. Why is financial reporting actually important? Well, the first reason is it's important for you to evaluate your operations. You can actually use financial reports to see how efficiently you are operating your business, whether your operations are generating or consuming cash, how quickly you sell your inventory, how much debt you have in relationship to your assets, and so on and so forth. Another reason why financial reporting is important is because it shows you the financial state or condition of your company. Potential investors or creditors, such as a bank, might want to know how well your company is doing before they invest. So financial reports or financial reporting is actually a way for investors or creditors to sort of gauge the safety and profitability of their investments. So any kind of stakeholder will want to know where their money went and where it is now, and kind of what is it doing, right? Another reason is for financial reporting is you can actually analyze your cash flows. So your company will incur cash inflows and outflows during a certain period. And this cash from all resources or sources is actually what pays investors back. So it's always a good insight to know how your cash position is. You can also use financial reporting to sort of plan, forecast, and make decisions. So typically what we would do is we would generate an annual plan at the beginning of the year, and then sort of look throughout the year how you are comparing against that plan. And from that, it helps you, it's essentially a tool to make decisions. And last but not least, you are required by law to generate certain statements for tax purposes. So the Internal Revenue Agency will use these reports to make sure you pay your fair share for taxes. So when financial reporting is done right, it will provide a picture of your company's revenues, expenses, profits, capital, and cash flow. Now let's talk a little bit about the what. When we talk about financial reporting, we typically talk about 3 statements, and these statements are called balance sheet, income statement, sometimes you'll hear the profit and loss statement or P&L, and the cash flow statement. There is another one, a 4th one. It's called the statement of shareholder equity, and it kind of shows how the shareholders' equity is changing over time. So sometimes you'll see this as a 4th statement. Those 3 statements that I just showed you on the previous page, they are actually interrelated. And I tried to sort of come up with a little graph here that shows how those 3 go together. So when we look at a balance sheet, the balance sheet is a snapshot in time, a snapshot of everything the company owns and what it owes. And the difference between that is the equity. The cash flow statement, the income statement and the cash flow statements, you can think of those sort of as videos that highlight what happened to 2 very important accounts of that balance sheet over time. So when we look at this a little graph here, this little depiction here, you can see you have a balance sheet in 2020, right? And then you have a balance sheet a year later in 2021. And you're going to see a change in cash from one statement to the other. And you're also are going to see a change in equity from one statement to the other. And the income statement is sort of a video that shows you how this change in equity from one statement to the other came about. And it divides that change in equity into revenue and expenses. Revenue will increase your equity, expenses decreases your equity, the difference is the net income. The other statement is the cash flow statement, and cash flow statement sort of highlights or tells you what happened in your cash account or what happened to your cash from one period to the other. And the cash flow statement is organized into three broad categories called the cash from operations, the cash from investing, and the cash from financing. And all those three make up the change in cash. So again, it's sort of a video or like it highlights or shows you what happened in that cash account from one balance sheet to the other. So let's talk about those statements a little bit. Let's start with the balance sheet. I already said that the balance sheet is sort of a snapshot or a point in time of everything your company owns. Those are we call this the assets, and everything it owes. So those are the liabilities or claims against those assets. And the difference between what the company owes and what it owns is what we call the shareholder equity. Sometimes you'll hear owner equity, you'll hear net worth, or you'll hear equity. Those are all synonyms for the same thing, namely the difference between what the company owns and what it owes. And shareholder equity itself is a very similar concept to home equity, right? So when you think about the value of your home, right? This is what you own, minus the mortgage that's outstanding against it, that gives you your home equity. Very similar concept. The input for the balance sheet or any financial statements are essentially recordings of business transactions. So your accounting system or your accountant or bookkeeper will record all business transactions in the accounting software. And these recorded business transactions is what underlies the financial statements. And for each of those transactions, we have a basic relationship that holds. We sometimes call this the accounting equation. And this basic relationship says assets have to equal liabilities and owner's equity. So this relationship holds over each business transaction that you record, as well as over the entire business. Okay, so what are assets? Assets is everything that the company owns. So those are essentially resources or items of value that a company has, such as cash, inventory, land, equipment, buildings, any type of tangible assets, but also intangible things like a patent, for instance. Liability is the debt that a firm owes to others. And owner's equity is the difference between assets and liability. And I put here that it's based on historical values, obviously, because it's reported based on historical happenings. So this is kind of the basis. So what I thought we could do is sort of look at how these business transactions that you have on a day-to-day basis sort of manifest themselves in accounting, to sort of give us an understanding how those financial reports come about. So here, I brought you an example of a company called Knit World. So this company was opened in 2020 by an owner. And then you can see here some typical business transactions. So the owner probably took some of her savings, right? In this case, $30,000, borrowed some money from others, in this case, $20,000 to get started. And she purchased some fixtures and equipment and merchandise. She sold, she was successful and sold product in her first year, some for cash, others was on credit, and she's still waiting for that at the end of the year. She paid some salaries. She also purchased more merchandise, and so on and so on. I'm not going to go into each of those transactions, but we're going to go through a couple just to show you how this principle holds. Okay. So here, let's start with the first one, right? So we said she invests $30,000 of her savings and borrows another $20,000 from others. So in total, she has $50,000 in cash. So her starting cash balance is $50,000, right? She has $20,000 in loans and $30,000 of her own savings. So this is her owner's equity. And you can see cash, right? Assets equals liability plus equity. So the left side is equal to the right side. If I now go ahead and go down all of these business transactions, you're going to see that this principle always holds. So if I pick, for instance, this line here, all right, we said she had sales of $100,000. And if you recall earlier, I said any type of revenue, right, will increase owner's equity. So this is the $100,000 where the equity goes up. And on the left side, we have cash and accounts receivable. Well, why is that? Well, because not all of the $100,000, right, has she been paid for yet. So when you sell something on credit, you will record the sale in your books, right? Your accountant will record the sale in your books. But you will also record what's called an accounts receivable in the amount of the cash that you're still anticipating to receive, right? So if you made sales of $100,000, but $90,000 were in cash and $10,000 are still to be paid, then $10,000 will go into those accounts receivable. Let's pick another one here. For instance, salaries. Oh, I forgot to mention, sorry, before we go on. Again, you can see the left side, right, is equal to the right side. So on the asset side, we have a cash that goes up and accounts receivable that goes up. And on the right side, we have equity goes up. Again, the left side is equal to the right side. And we can pick any of those transactions and we will see that the left side is always equal to the right side. And if we were now to go ahead and add up all these numbers here in this column, right, and did that for each of the columns, then the total that we would record down here on the left side, right, the asset side, will again be equal to the total that we record here. So this is what I was saying earlier, this accounting equation, this basic relationship holds for each business transaction and it holds over the entire business. And now that we have this, we can actually very, very simply rearrange this table to generate our first financial statement, namely the balance sheet. All right, so if I was to take this table, right, and rearrange it so the columns here become actually the lines in your balance sheet, then we can generate a beginning balance sheet and we can generate an ending balance sheet, right? So if let's say this is the start of her business, right? She has invested, she had those $50,000 in cash. She purchased some merchandise with it. Then that means she has about $30,000 in cash. $10,000 in inventory, right? This is what she purchased to sell. She also purchased some equipment from it, right? So maybe furniture, fixtures, cash register, etc. So this is all of her assets, and you can see they're now listed here in this balance sheet, right? So this is the cash. Inventory is listed here, and anything that we anticipate that we can turn into cash within a year is what we call current assets. So her current assets are $40,000, right? $30,000 in cash and $10,000 in inventory. And then she also has these fixed assets, right? Her furniture, cash registers, and so on and so forth. So her total assets are $50,000. And on the liability side, she doesn't have any current liabilities just yet, but she has that loan that she has from friends and family and her own savings that she invested in the business. So total liabilities and equity are $50,000. After everything that happened throughout the year, we got to this line down here in our table, right? And if we now do the same thing and sort of make those columns again, the lines in the balance sheet, you can see that, you know, the cash is now 31,000. She has accounts receivable. She also has inventory still left at the end of the year. Her fixed assets went down a little bit. That's because of depreciation. I'm not going to go into detail about this, but essentially what you do with fixed assets, you have the opportunity to depreciate them over the life over the usable life, right? So your furniture or your cash register that are substantial investments, right? You can depreciate those. So in this case, we assumed that $2,000 of the 10 were depreciated. So this gives us the total assets, right? And then on the liability side, she still has some vendor bills to pay, right? Those are her accounts payable. Her loan amount is still there, but her equity changed to 36,000. So this is the beginning balance sheet that she had when she started the company, and this is the end where she ended after a year. So when we look at this previous picture, right, we basically see this balance sheet and this balance sheet. And we notice that the change, right, went from the cash went from 30,000 to 31,000. And the equity went from, the cash, let me go back. The cash went from 30 to 31,000, and the equity went from 30 to 36,000, right? So we have a change in those two very important accounts. And now the income statement and the cash flow statement is going to take a deeper look and tell us how those changes came about. Okay, so we went from balance sheet to balance sheet, and now we're going to look at the income statement to figure out how this change in equity, this $6,000 difference, right, from one year to the other, came about. So what I've brought you here is a very basic layout or structure of an income statement or profit and loss statement. So it starts with the revenue, right? The money that you get in from your sales. You subtract out your cost of sales. Those would be your cost of goods sold or any other costs that are related directly to sales. So we call those cost of sales. This will give you your gross profit. When we then subtract what we call the operating expenses, so we call those SG&A, but this SG&A means selling, general, and administrative expenses, and depreciation. We get to operating profit. So SG&A could be, for instance, marketing, it can be utilities, and anything that any other operating expenses that your business incurs. So when we subtract those from the gross profit, we get to what's called the operating profit. Sometimes you'll also hear EBIT. This is the earnings before interest and tax. So this is really what your company is able to generate in earnings, right, or in profit before you take out interest expenses and taxes. So interest expenses is what you have to pay for any outstanding loans that your business has, or debt that your business has, to be more broad. If we subtract those from the EBIT, we get to the earnings before tax. Sometimes you'll hear this as EBT. If we then take out the tax provision, so the amount of money that you calculate to be paying in taxes, you're going to get to the net income. So now let's look at how this looks for Knitworld. So we said the company had sales of $100,000, right? So this is her revenue. She as the owner and a help paid herself salaries and the help in the amount of $42,000. Now you can argue that this might not be a direct cost or a direct cost of sales. I put it here. It's arguable, but let's just keep it here for now. And then she also had purchases, so her cost of goods sold, right, for $18,000. If we subtract those two numbers from the $100,000, we get to the gross profit. She also had other expenses, rent and utilities of $30,000. We talked about the depreciation that she has. So if we subtract those two from the $40,000, we get to the earnings before interest and tax. And if we subtract out the interest and taxes, we get to the net income. So now you can see, right, how this change from 30,000 to 36,000 came about. And when we look at this income statement, right, we can calculate a couple of things that might be interesting for us. If we, for instance, take the gross profit, right, so that's the revenue after all the direct costs, and divide this by the revenue, we get to what's called the gross margin. And in this case, it's 40%, right? So what this means is that for 60%, right, is used for used for direct costs, right? So for every dollar that you earn, or from every dollar that your business earns, 60 cents is used to cover direct costs or your cost of sales. And 40 cents, right, the 40%, is left to cover your fixed costs and your profit. And this is actually something very important to know, right? Because what happens when you have, when your gross margin is, let's say it would be 60% instead of 40%, right? Then that means 60 cents of each dollar that you earn is available to cover your fixed costs and your profit. By the way, the income statement does not necessarily tell you that whatever it does not distinguish, I should say, between fixed and variable costs. But we can certainly assume that any type of direct costs vary with the sales. Okay, so it's important for us to know what that percentage of fixed costs, right, in our business actually is, fixed versus variable costs. And why is that important? Well, because when your sales go down, right, and your variable costs, you can adjust, right? For instance, you can purchase less merchandise, right? If you notice that you purchase less merchandise when you notice that you can't make the sales, or you might be able to maybe, in this case, let go of your help, right? So you have much more opportunity to intervene in those direct costs and get those down as compared to the fixed costs, right? In our other expenses, we had rent and utilities, right? In this case, even if your sales are only 80,000, right, you might not be able to reduce utilities and rent. So it's important to know how your cost structure is, right? What are your fixed costs versus your variable costs? In other words, how much revenue do you have to make to sort of cover those over a certain period of time? Okay. The other sort of ratio that we can look at is we can take the net income and divide it by the sales or the sales revenue. In this case, this is what we get, what we call, when we do this, we get what's called the profit margin. In this case, it's 6%. So this tells us what? Well, it tells us that for every dollar earned, right, 6 cents goes into profit. So for every dollar we earn, 6 cents is profit. And again, I haven't gotten into ratios yet, but it's important to sort of look at this, these ratios over time, right? How is your business doing over time and in comparison to maybe others in your industry? All right. So now we kind of know how this change in equity came about, right? Now, the next thing we're interested in is how did the change in cash come about? And this is, we can do this by looking at what we call a cash flow statement. So a cash flow statement simply shows the flow of cash in and out of your business. It is the net change of cash. The net change of cash is shown. This is this change, right, from cash from one balance sheet to the other. And this change is a total of the net cash from operating activities, from investing activities, and from financing activities. And because we look at the cash, right, it is a tool to sort of determine the short-term viability of your company. And particularly your ability to pay your bills, because when you're no longer able to pay your bills, you're going to get in trouble. Here is just a simple example from Google, right? When we look at this, we can see that the company generated cash from operations, right? And it used its cash in investing and financing. Okay. So how do you generate a cash flow statement? Well, there are a couple of ways to do this. One way to do is actually to record all your cash in and outflows. However, that unless you do what's called cash accounting, you might not be able to have that information readily available, because typically what we do in accounting, we have what's called the accrual principle. So we record revenue when we're fairly certain that we can get it, right? And expenses when they are incurred. That's not necessarily the same time the cash is flowing. So what we have to do is we have to make some adjustments. So we generate this cash flow from operations actually by taking the net income and then adding non-cash expenses, in this case, for instance, depreciation. And we're making some adjustments. I'm not going to go into detail here. And then we add or subtract all changes in current assets and liabilities. And this is going to end us with the net cash from operating activities. So again, when we look at KnitWorld, we can generate this cash flow statement fairly quickly. So we said we start with the net income, right? So the net income from the income statement, right, was $6,000. Then we said we add non-cash expenses. In this case, we have depreciation, right? So we know our depreciation was $2,000. We add this here. And then we add or subtract all changes in current assets and current liabilities that are actually not considered financing and investing. So let's look at a couple of those from our balance sheets, right? So for instance, accounts receivable, right? So at the beginning of our operations, right, the balance sheet had no accounts receivable. At the end, it had $10,000 in accounts receivable. Remember, that's a $10,000 of sales that you haven't been paid for yet, or KnitWorld hasn't been paid for right? So we have an increase in accounts receivable. So your cash, right? Cash is actually trapped in there because you recorded the sale for it, but the cash hasn't flown. So we have to subtract this out. Same goes for the inventory, right? So we have an overall increase in inventory of $2,000. Again, you trap your cash in here, so you have to subtract it out. And your accounts payable, right, increased from 0 to 5,000. And this is where you purchased merchandise already, but you haven't paid your vendor yet. So this is actually good for you, right? You have your merchandise already, but you haven't had a cash outflow for that yet. So this is why this gets added. So if we add all of this up, we get to our cash flow from operations of $1,000. Okay. So once we have that, we need to look at cash flow from investing and cash flow from financing. Cash flow from investing is any kind of activity, or this is the cash flow from investing, I guess I should say, shows how much cash has been generated or used in certain investment related activities. Okay, so this can be purchases of physical assets, investments in securities, and the sales thereof. This is cash flow from investing. And cash flow from financing is essentially the net amount of funding your company generates. So this is if you got a loan, for instance, the cash from that loan, if you issued stocks or shares, right? Or if you said, to a potential investor, give me some money in exchange for a share in my equity. You purchased your shares, you paid some dividends, or you made some principal payments, right? So if you had a loan outstanding and you made some payments against the principal of the loan, that will be a cash outflow from financing. So for simplicity, let's just assume we don't have any of these. So then our change in cash, right, that $10,000 is essentially driven by this cash flow from operations. Okay. So this is sort of a quick overview of how these three statements are generated from what happens in your business and kind of how they go together. Now, once we have those statements, we can actually work with them. And this is what I call, or what we call, ratio analysis, right? And this ratio analysis helps us to evaluate your firm's performance. And it sort of highlights certain important information from financial statements. And you can sort of look at profitability, efficiency, and liquidity of your company over time, and also in comparison to other companies. And what's very important when we look at those ratios is whether is the fact that we're looking at ratios, right? Because whether a number on your income statement, right, is good or bad, depends on its relationship with other numbers. So what I mean by that is, let me give you like a very simple example. Let's say your profit, right, was $70,000. Is that good or bad? Well, that depends on what your sales were, right? If your company made $700,000 in sales and you had a profit of 70,000, right? That's a 10% return. So that might be pretty good, right? Versus, let's look at the same $70,000 and let's say the company had $7 million in sales. Then your profit is only 1%, right? So this is what I mean. We need to look at the relationship of those numbers. So never look at them in isolation. Look at the relationship to other numbers, how they compete and how they compare over time. So what are a couple of typical profitability ratios that we can use? One typical one is the ROE, or return on equity. It's your net income divided by your owner's equity. And it shows how efficiently the owner's capital, right? In this case, how efficiently Kira employs the money that she put into her company, right? How efficient are we using that capital? The return on asset is the net income over assets, and it shows how efficiently your company allocates or manages resources. We already talked about profit margin and gross margin, right? Profit margin essentially shows you the fraction of each dollar in sales that trickles down through that income statement into profit, right? For Knit World, 6 cents on every dollar is profit. And the gross margin is essentially the contribution of each sales dollars to fixed costs and profits, right? We had that as that example as well. So we can calculate those ratios, right, for Knit World. If we take the net income, the 6,000, and divide it by the assets, the 36,000, we get to a return on equity of 16.7%. So this seems okay, right? This is a good investment. What other investment can you make almost 70% on within a year? Return on asset is about 10%, and we already talked about profit margin and gross margin. So we look at this, right? And then we compare this maybe over time, right? And also in comparison to similar companies that are operating in a similar field as you do. Another set of ratios, it's what's called the efficiency ratios. So they show you how efficiently you operate your business. The first one is called the asset turnover. It's essentially your sales divided by your assets. And it shows you how many sales you can generate from each dollar that's invested in assets. Then we have what's called the inventory turnover. This is your cost of goods sold divided by your ending inventory, and it tells you how many times your inventory gets turned per year. The more, the better, right? If you're managing to turn your inventory more times than less, better for you, right? Make more money. Then what we have is called the collection period in days. So this is your accounts receivable divided by your credit sales per day. And this essentially shows you how good you manage your receivables, right? How quickly can you return those credit sales into cash? So it's the time between you make your sale and you actually collect the cash. So the shorter, the better, right? Shorter time means earlier cash inflow. And then you have what's called the payable period, which is your accounts payable divided by your credit purchases per day. And it's essentially the collection period that's applied to your accounts payable. So how quickly do you pay what you owe to your vendors? We can do those calculations again for Knit World. So the asset turnover is 1.6. So we can generate $1.60 from each dollar invested in assets. Inventory turnover, we take our cost of goods sold, right, divided by ending inventory is 1.5. So we managed to turn our inventory 1.5 times during the year. Collection period, right? Time between when we make the sale and when we actually calculate the collect the cash is 36 days or 36 and a half days. And the time between we purchase and we pay is 101. Now, I admit that this is probably based on the numbers that I included in this example. I don't think there's a vendor that will allow you to pay 101 days after you made a purchase. Typically, they expect you to pay within 30 days max, sometimes 60 days after you made your purchase, right? But if this were true, then this would actually be a very comfortable situation, right? Because you collect your cash faster than you pay your vendors, right? So you have cash available to you. All right. And the last set of ratios is what we call liquidity ratios and leverage ratios. So leverage is, for instance, your assets to equity, right? This is your total assets to your total shareholder equity. And it shows us the amount of shareholder equity that's used to finance the assets. Then for liquidity ratios, we have what's called a TIE, or times interest earned. This is your EBIT divided by your interest expenses. And this is the number of times the interest expense was earned over a period. And this is very interesting for a potential creditor, right? They want to know how certain is it that you can cover your interest payments, right? And potentially also make some principal payments. Then we have the current ratio, which is your current assets over your current liabilities. And it just shows you what can be turned into cash within a year versus what's due within a year, right? So you probably want this to be above 1, right? You want to be able to turn your more assets into cash within a year compared to liabilities that come due within a year. And then we have what's called the asset test, which is your current assets minus your inventory divided by your current liabilities. And this is actually a more conservative measure of liquidity, right? Because it says, hey, I take all my current assets, but I take out inventory because I might not be able to liquidate that as quickly. And I put that in relationship to the current liability. So again, when we look at this for KnitWorld, we take the assets, right? That's the $61,000 divided by the equity. So it's 1.7 times interest earned is 5.33. So the interest payment, right? The $1,500 that she has to make, we can see that here for friends, the loan of friends and family, she earned 5.3 times over. Current ratio is current assets to current liabilities is 10.6. So we can turn $53,000 of assets into cash within a year, and we have about $5,000 that comes due within a year, so that's pretty good. And then if we do the asset test and take out the inventory, we get to 8.2. So those are some financial ratios, right, that you can look at for yourself, and some of those might also be used by your creditors or potential investors. They will look at those as well, and those might actually vary from investor or creditor to creditor. Kind of depends what they are looking at. So this was the what, right? Now let's talk about the when. When should you actually do financial reporting? Well, you should always start with a plan before you actually start the reporting, right? And what I mean by that is not right now is actually a good time to sit down and think about what is my next year or my next 6 months going to look like? What do I project in sales? What do I project in expenses? And how does that look on a monthly basis, right? Think about that. Think about what do you think you can make in sales? Think about what kind of expenses you have, or think about your expenses and then think about what you have to make in sales in order to cover those, right? And by the way, don't forget to pay yourself. And then your reporting, right, is essentially done against those plans, right? So typically what we do is we have financial reporting on a monthly basis, right? If it's set up correctly in your accounting software, this is the push of a button, right? So on a monthly basis, you get your profit and loss statement, cash flow statement, and balance sheet, and you can look at how do those develop over time. And we actually call this, one way to look at this, right, is projections versus actuals, right? Where did we think we're going to land for the month versus where we actually came in, and why is there a difference, and what happens now, right? So if I projected $10,000 in sales each month for the next 3 months, right? And now it's the end of the first month and only 4,000 came in, then it's time to look at why did that happen, and is this going to go on in the next 3 months, right? Or because then I might have an issue if my expenses were sort of projected in relationship to those sales, because I might not have enough money, right, to cover the expenses. So this is kind of a way for you to gauge how your business evolves over time. Okay. And when we do financial reporting or the plan in the beginning, this can also be used as a way for you to create budgets, right? You sort of project revenue, you project what you think you're going to make in sales, you project what your expenses you have, and this is the basis for budgets, right? So this is what you know you can spend on certain things. So it's a way for you to sort of make sure to stick with those, or to stick to that plan, right? Or be aware that if you go over the expenses that you have planned, this is going to affect your bottom line, right? So it's a way for you to sort of, on an ongoing basis, monitor how you run your business. So this was the when, and let me finish with the how. So you saw, right, that we went ahead and we prepared the statements via Excel, and you could technically do this, right? You could record all your business transactions in an Excel spreadsheet and generate these statements, right? But that's probably not what you want to spend your time on. So it's much better to use an accounting software, for instance, QuickBooks. There's also Soho Books, FreshBooks, that will do this for you, right? So typically what you would do, or what a bookkeeper will do, they will set up these statements one time, or the generation of the statements, and you can also work with them to, get the plan into the system, and then it's literally the push of a button each month that shows you, okay, this is what the plan was, this is where we came in actuals, or this is how something develops over time. And then you can basically take a look and say, okay, what happened? Why is it different from what I anticipated? So when it comes to the how, it's typically done via an accounting software such as QuickBooks, and I would recommend to have those statements prepared by your bookkeeper, who enters all those business transactions into QuickBooks. All right, that's all I have. Now, let me know if you have any questions. Thank you for your time and for listening to what I had to say, and I'm happy to take questions now.
Yes, we do have a couple questions. So just as a reminder, you can put your question in the Q&A tab. I'm also willing to unmute you if you'd like to raise your hand and ask your question out loud. That is also an option. Don't forget, we also have Debbie Dobbins from East Cambridge Savings Bank, and she can answer any questions as well. So question number one, why do you add non-cash expenses to a cash flow when depreciation, for example, doesn't impact the cash you have on hand?
This is what I said before with the accrual principle, right? So we have to sort of, I guess, restate what we recorded in an accrual principle into actual cash, right? So when we think about this, right, in your cash flow statement or depreciation, for instance, right, depreciation is not really an outflow of cash, right, in that particular period that you reported for. So like in our case, right, we had $2,000 in depreciation, but these $2,000 in depreciation were expenses that reduced your net income, but the cash had already flown at the time you made that purchase, right? You purchased your equipment. So those $2,000 reduce your net income, right? But they're not a cash outflow in the particular period. So this is why we have to add them. I hope hope that answered the question.
How are these ratios affected when you have a service-based business since there's no inventory?
There are, that's a good question, actually. So I sort of looked at it from a typical sort of production / inventory business. The ratios, there are certain ratios that you probably use for a service business more compared to a merchandise business, for instance. But what the ratios that you use or that you typically use sort of often are dictated, right, by who gives you the money, essentially, that you're working with in your business, right? So for instance, a lot of times you'll look at the EBITDA, which I haven't really talked about, but it's essentially the earnings before interest, taxes, depreciation, and amortization. So this is sort of like what is really the fundamental earning power of your business before you take out, for instance, depreciation and amortization. Sometimes you also use what's called the AEBITDA, which is an adjusted EBITDA, where you take out other expenses that are one time. So you kind of want to figure out what your company is sort of able to produce, if you will, in income without any one-time expenses. So there's different, I guess, to make a long-winded answer short, there's different ratios that you could look at depending on the industry you're in.
Okay. Debbie, did you have anything you wanted to add from the bank side?
Well, not really. I just wanted to say I commend everybody who took a Thursday evening to do this critical education. And as a commercial lender to businesses, most banks wouldn't expect you to have all those ratios calculated when you first show up to start talking about possibly borrowing money, but definitely the balance sheet and income statement and a cash flow if you can. And you would want to do that before you approach a bank. And Robert and I would be glad to take any questions now or offline. But Nicole did a great job. Thank you, Nicole.
Okay.
Thank
All right.
you.
We'll be sending out a follow-up email and it'll have the contact information for the bank and some information from the presentation today and how you can get a score mentor, all that wonderful things. So I want to thank everyone for joining us today and have a great rest of your evening.
Thanks, Tracy.
Thank you.
Thank you.